Okay, hi everyone. Welcome again to AuthorStory. I'm Alexander Lim, your host, and for this episode, I'm interviewing Gary Stone, author of the book Blueprint to Wealth: Financial Freedom in 15 Minutes a Week. And for those of you following along who are interested, you can go over now to the Amazon link in the description below the video and check out or get a copy of Gary's book. So Gary, welcome to AuthorStory. I must acknowledge that you are our first guest for 2017, so thanks for being our first guest for this brand new year.
Oh, fantastic. No, thanks for having me on Author Story, Alex.
Cool. So Gary, first off, can you please tell us a little about yourself and the book? What's your author story?
Well, my author story is I never dreamt I'd ever write a book, but I was in the mainframe computer industry in the 80s and the 90s, and did pretty well at that. And through commissions and selling large mainframe computers, I got commissions and had to find an avenue in which to invest them. And having a little bit of a left-centered brain, and having studied mathematics and computer science at university,
Right.
I started off on this journey of working out the best avenues to get growth for small and large amounts of money. That started back in the late 80s.
Right. Okay. So essentially, you're like a salesman. We start off as a salesperson.
Yeah, well, I started off as a technical guy,
Oh,
actually,
okay. Okay.
on mainframe operating systems, and then somebody noticed as a 26-year-old that I had a flair for account management and selling and that, and so I moved over into sales and did pretty well at it. Yes.
All right. So, so you didn't? Did you get? I'm just curious. Did you get into any sort of job as in like the money markets or stockbroker or anything like that?
No, no, I didn't. I started this investigation and stumbled forward with making lots of mistakes and learning and analyzing. I did a lot of analyzing,
Right.
looking at financial reports, annual reports of listed companies, balance sheets, P&Ls, and then I started down the journey of looking at price movement of stocks and indices, and that whole area is called technical analysis or charting, and that's what gripped me. And then I started a business in 1995, where I kind of combined my computer science skills, mathematics skills, and this huge passion I had for the stock market, and started providing services, technical analysis and charting software services, and data for individual investors, everyday investors.
Right. Okay. And from there, I mean that. So that's essentially how you really work the investing and in money markets and all that stuff. Then.
Correct. And
All right.
I had an insatiable appetite to want to learn more, and then I read just huge amounts of books. There weren't many available in the 80s,
Okay.
but more and
Right.
more came out in the 90s,
Right.
and I decided to go down what's called the mechanical investing system path, where you actually create a mechanical investing system that alerts you when to buy and sell, and you look at price patterns of price movement in the financial markets. And so I started that mechanical investing journey some 20 years ago.
Okay. And of course, after 20 years, I'm sure you've gained a lot of experience and a lot of practice in it.
I certainly have, and yeah,
All
and a
right.
lot of it, a lot of it is psychology. So it's
Okay.
getting the right mindset, because you're never going to have 100% success with any investment you have in the financial markets, and you have to learn to deal with having losses. And the whole game is one of what I call gaining a probabilistic edge. It's all about probabilities. There's no dead certs,
All right.
and having a probabilistic edge means that you're going to win some, you're going to lose some. In
Right.
fact,
Right.
the odds are you probably might lose more trades than what you win. But when you win, your average size of your winner is much, much bigger than the average size of the losers. And that's how you become consistently successful and build equity curves and build wealth.
Right, cool. So, next the book. I find it interesting that your book addresses the kind of thing that should be taught in school but isn't, which is financial smarts. I mean, let's face it, schools nowadays they teach kids the skills to handle a job, not how to handle money, much less achieve financial independence. And that's what your book is about. Would you mind please telling us a little more about the book and what it's all about?
Alex, you're absolutely spot on. You know, the I guess the background theme of the book is the power of compounding.
Hmm.
And you know, my wife's a teacher, and I've got one of my best friends is a teacher. He's been a principal of a fairly good private school in the country that he lives in.
Right.
And I ask, and through these people, there's other teachers I've met, and you know, whilst compounding is on the syllabus, I've had done interviews in the United States and asked the same question
Mm-hmm.
um, with people who have access to schools. Whilst compounding seems to be on the syllabus of most schools,
Right.
it's the actual individual schools and teachers that have discretion as to whether they can't cover the whole syllabus,
Right.
so they leave stuff out. And it's amazing how often compounding, the power of compounding, is not taught, even though it's on the syllabus. So you know, if part of what we do here and all the radio interviews I'm doing around the United States gets this theme of compounding across, I think I would have achieved a lot.
Cool, fantastic. So, Gary, what inspired you to write this book? Was there any one particular incident that made you think, I should write this out, or did it just like build up on you over the years?
Yeah, it built up over time. I had a lot of customers that they've had my business over the years,
Mm.
repeatedly. People that didn't know each other from a bar soap
Mm-hmm.
came to the same conclusion, that and I repeatedly had requests to write a book and take the information that I was presenting, face to face and webinars over the years.
Mm-hmm.
And then I met an individual who'd written two books to that point. A gentleman by the name of Mark Douglas, who resides in the United States,
Mm-hmm.
and we became friends, and he urged me and convinced me to put pen to paper. That was some 12 years ago,
Mm-hmm.
and I had a couple of bashes at it, but it took me 12 years to eventually get a book out with
Okay.
the subject matter that I wanted to. Yeah.
All right. Okay. And it's out right now, so that's a lesson in persistence right there.
It is. I tell you, the toughest. It's the research that went into the book, and I'm sure most people that write books, non-fiction books that do research, would go through the same journey. But also the editing process of just verifying and checking that the
Mm.
research is all correct. Yeah, it took 3 years.
Mm.
It's a massive project. It was far bigger than I thought it would be. Uh,
Right.
but what drove me to do it, to spread the message of that investing in the stock market is a lot simpler than what the financial fraternity and establishment wants us to believe.
Mm. Okay, got that. Cool. So, Gary, before we get deeper in the book, would you mind defining for us some terms that you use, which our listeners may or may not be familiar with, or, if they've heard them, they don't really know what these mean?
Mm.
First off, mutual funds. What are mutual funds?
Well, a mutual fund is just to use very basic terms, a sum of money that is managed by a firm, and who's called a fund manager, and they manage the money on behalf of individuals who invest any sizes, anything from $1,000, even $500, to large amounts, multiple hundreds or even millions of dollars get provided to a fund manager,
Mm-hmm.
and then they disperse that money they invested across different asset classes.
Mm-hmm.
Some will go into a single asset class,
Mm-hmm.
and they unitize to work out what the value of the overall fund is. And at any given day or week, they work out a unit price
Mm-hmm.
based on how the money that's been invested is actually performing.
Okay, got that.
Yeah.
So a second term, stock exchange index. What is this?
Yeah. Yeah, now, a stock exchange index is is a representation of how the stock market, the overall stock market, is doing, how it's performing, whether it's rising or falling. So the stock market, the most well-known stock market index in the world, is probably the Dow Jones Industrial Average,
Right.
and that's just got 30 stocks or 30 constituents or 30 components they talk about, and a component is an individual stock. So it's made up of
Mm.
30 stocks, and then how each individual stock moves on a particular day, they average that out account what the movement was of the index. The other index, stock exchange index that is very well known around the world is the S&P 500. Those are probably the two most well known. And then the third big one, is the NASDAQ 100 index, which comprises 100 stocks. And of course, the S&P 500 I just mentioned is made up of 500 constituent stocks.
Okay, so in other words, an index can be made up of any number of stocks.
Correct, and there's some others which I should mention. My favorite one, which is the S&P 400 index. Now, the S&P 500 are the top 500, the largest, the biggest stocks that are listed on the New York Stock Exchange and NASDAQ as well. So they're the biggest 500. The S&P 400 is the next biggest 400, and they call that a mid-cap index.
Okay.
And then there's an S&P 600, which is the next 600, so they call that the small cap index. So if you add those together, that's 1,500 stocks. And there's also an S&P 1,500 index, which is all of those 1,500 stocks added up. And
all right.
And that's an average. So we call it a stock market average. Some people call them the averages rather than the index.
Okay, got that. Okay. So the third term I want to ask about is target date fund. What is this?
Right, a target date fund is a relatively new mutual fund, a subset, a different kind of mutual fund. It's a balanced fund as opposed to being an equity mutual fund. An equity mutual fund would typically just invest only in stocks.
Okay.
Okay, and it would be stocks that the mutual fund managers are pick and choose based on them doing some sort of analysis. So that means that they are not picking the stocks that are in the index. They're picking different stocks with a view to try and outperform the index. A target date fund is a subset of what's called a balanced mutual fund. A balanced mutual fund is a mutual fund that invests across different asset classes. In the United States, this is mainly stocks and bonds.
Okay.
And bonds are a fixed interest investment asset class, and you can get other asset classes such as infrastructure and property and commercial property, and you can even get private equity, which is getting into hedge funds and things like that. But each one of those is an asset class, and cash is also an asset class as well.
I see. Okay.
So what a target date fund is a balanced fund between, and most of them are just really between stocks, or equities is also another name for stocks, and bonds, and they divide the capital up to some degree between the two. Now, what the target date fund is it picks a date in the future. So, for instance, there would be a 2030 target date.
Right.
And what would happen is now with 13 years to go to 2030, which would typically be when somebody would be retiring, they'd pick a 2030 target date fund. If that was close to the year they'd be retiring, so it might be people in their probably in their mid to early 50s.
Right.
And as you get closer to retirement, the amount of capital that's invested in stocks or equities reduces, and the money that comes out of stocks and equities goes into bonds. So the asset mix between stocks and bonds changes as you get closer to retirement, and that's what a target date fund is.
All right, interesting, cool. Yeah, it's first I heard of that. All right, so thanks for the explanation. And finally, I'd like to differentiate between bear market and bull market. I mean, I'm sure people hear about the bears and the bulls all the time, but what is this exactly?
Yeah. Very simply, a bull market is a market that's rising, and a bear market is one that's falling, that's declining in value. Now, stock markets will never go up or down in a straight line.
All right.
They go up and down, or so they'd go up. A bull market would be a rising market, but it would go up, and there'd be little steps along the way, up and down steps on the way up. So that's a bull market, a rising market. A bear market's a falling market.
Okay, I got that. Okay, so I must admit, I've heard stuff, conventional stuff like invest in the market for the long term, and by long term, people talk about 20, 30 years. But I noticed that you set your investment horizon to shorter, around 5 to 7 years. Why would you set an investment horizon for that particular length if we're talking about investing?
Yeah, well, I actually don't.
Okay, a mistake.
There's two investment horizons, two category of investment horizons that I discuss in the book.
Okay.
The one is long term, and that's basically greater than 15 to 20 years. So there we're
Oh, okay.
talking 15, 20, 25, 30, 35, even 40 years, right? So people in their, yeah, guys in their people in their 20s, have 40 to 45 years to retirement.
Right.
So that's long term,
Mm-hmm.
and short to medium term with a view to retirement and nest egg building would be, from an investing perspective, would be up to about 7 years. And I do differentiate between those two. So people that are in their 60s would have a less more risk averse risk profile, because they don't want to suddenly be hit with a big bear market where the stock market falls by 50% again, such as it did in 2008.
Right, definitely. So the 5 to 7 years, then, this would be what you would call an intermediate term?
It is from an investing perspective. Now,
Yes.
if people are listening who are traders, and I've done a fair amount of short-term trading, their time frames would be shorter. So talking 7 years to a trader, that would be long term.
I
Okay,
see. Okay, all right.
so there's a difference between trading and investing. So if you're
Oh, okay.
investing for the long term, where effectively you're going to leave your money invested in a particular pool of money, if you like, a portfolio for many decades,
Right.
that's investing. But people can invest short term in instruments such as foreign exchange
Right.
and leveraged instruments, futures, and things like that, which would be trading.
Okay, I got that. Okay, I got that. All right, so there's a myth, I know, I guess you could call it a myth, that you tackle in your book, the one that talks about timing the market, which, I believe is the strategy of investors working to miss out on the worst day of the stock market so they can
Yeah.
maximize their returns. Why is this a myth, if it is a myth, and what's the alternative, or the basis of the alternative, so investors can maximize things?
Yeah, that's a great question, and people are going to have to listen carefully here, because the those of us that are investing for retirement, that have many decades to go, to multiple decades, greater than 2 decades, greater than 20 years,
Right.
there's a risk that they need to, that people that are closer to retirement, say within 5 to 15 years, and that risk is a sequence of returns risk, which basically says that the closer to retirement, or even during retirement, if you have a large bear market, a big 50% fall, that fall is going to have a far bigger effect on your retirement nest egg than if a 50% fall occurred when you are 35. And the reason for that is the amount of time it takes for the stock market, with the reinvestment of dividends, to recover,
Right.
which on average is about 4.5 years. Right. So if you've already retired and you're 70 and we have a big 50% fall in the stock market,
Right.
you don't have any income to allow you to continue investing, because you're drawing down.
Right.
So the idea is, as you get closer to retirement, is to introduce a different risk management strategy, which is to time the market. But people up to their early 50s don't need to time the market with the one strategy I talk about in the book. They can just buy and hold
All right.
and continue to add to a particular, well, what we're talking about is an index, which is an index exchange traded fund, which we'll define in a moment. But let's just get back to the timing myth. So the timing myth is one where mutual funds and the financial fraternity and establishment say that you can't time the market. And what I prove in the book is that is a myth. And one of the big bits of logic that they use to say you can't time the market is, over any 10-year period, is they say, if you remove the 10 best days, the best 10 return days
Right.
from an index over a period of 10 years, it'll effectively wipe out all the accumulated returns for that 10-year period. Now, just on its own, that is true. It's not untrue. It's a fact.
All right.
And you can do that with different 10-year periods, and look at the 10 best return days of
Right.
the index, and you will find that's mostly true.
Right.
The problem with it is that they don't also do the flip side of that, to find out is, what if you remove the 10 worst days? And what if you remove both the 10 best and the worst days? And what that research shows, that over any 10-year period, if you are not in the market for the 10 worst days, you do far, far better than if you'd stayed in the market the whole time
Mm.
and had both the best and the worst days. So what the exercise shows also, and this is the real clincher, is that the best days occur within very close proximity to when the worst days occur.
Mm.
So if you miss both the best and the worst days, you do far, far, far better, which actually goes to prove that it is better to time the market. Now, because the worst days are in close proximity to the best days,
Right.
I'm not talking about trying to time the market on a day-by-day basis. I'm talking about trying to time the market on a week-by-week or month-by-month basis.
Okay.
Missing the worst days is actually not a difficult thing to do. It's quite simple to do.
Mm-hmm.
And that's what busts the myth that the market can be timed.
Mm. Okay. Cool. Got that. So I guess then it's definitely possible to outperform the market using this strategy.
It is, and but it's not intraday timing. It's not somebody sitting in front of a computer screen trying to time the market every day.
Right.
It's what we call what I call longer term alert signals for
Okay.
timing the market. I'm not the only one that does this. There's literally hundreds or even tens of thousands of people around the world that do this, right? Um,
Right.
so it can be done.
Okay. Got that. Hang on a sec here.
Yeah,
All right. Okay. Sorry about that. Okay.
no
So
problem.
all right. So it's okay. I got it. Because usually when people think timing the market, they think like got to stay in the computer screen for like 24 hours a day and watch the
Mm.
stocks. They go up and down, then click when they start to go down and buy when they start to
A-
go up and stuff like
and
that.
that's not the timing I'm talking about. In fact,
Right.
in timing the stock market index ETFs that we talk about, we're talking about doing 2.5 to 3 trades a year.
Mm.
Okay,
Okay.
to
Okay.
try to avoid large bear markets. So it's what I call near passive, low effort timing of the market.
Mm. Okay, I got that. Okay, so, but I guess investors they still have to do their research, like on industries and on companies, see what works well long term, see what works well short term, right?
No, they don't.
They don't. Okay, all right.
Well,
Okay.
well, I mean that's one way of doing it, but what I'm putting forward in the book is that you don't need to do that. So the
Mm.
method I'm talking about and the instruments that I'm talking about, you don't need to do any value investing. So
Okay.
value investing is when you analyze balance sheets and P&Ls and you
Yes.
and you do
Yes.
stock picking and
Yeah.
you get broker reports and I mean that just consumes hours and hours and hours of time, right?
Yep. It does.
So what I'm saying is forget about all that. What you do is you invest in the index, and the way you invest in the index is you focus on 2 or 3 or 4 index ETFs, and an index ETF is an index exchange traded fund,
Hmm.
which is effectively an index mutual fund that's listed on the stock exchange.
Right.
And so that would mean that you go and buy in the one that I prefer, the S&P 400
Hmm.
mid cap index.
Right.
And by doing that, your money is actually getting diversified across 400 stocks.
Hmm.
Now, somebody who goes and picks stocks and does all the research to pick stocks, invariably there are large cap stocks and small cap stocks
Right.
that delist. They delist and they disappear off the stock market. And if you've got
Right.
money invested in those, you lose all of your investment in that stock.
Right.
An index cannot go to zero. An index cannot delist. So if you invest in the index, you can buy and hold it. You can buy and hold that exchange traded fund,
Mm.
and it'll continue to rise in the long term
Mm.
because indices are rigged to rise.
Right.
Why are they rigged to rise? Because when a constituent falls out of the index, a new one and one would fall out of the index because it's a laggard and it's falling and its price is decreasing and its market capitalization is falling.
Right.
The index custodians will replace the one that's falling with one that's rising.
Mm.
So over the long term, indices are rigged to rise.
Interesting. Okay. Interesting. Okay, got that.
Yeah.
So, Gary, I'd like to address a potential fear amongst investors, and that's the bear market. So,
Yeah.
I'm sure a lot of our listeners would be familiar with such relatively recent events as you mentioned the subprime mortgage crisis of 2008, And the older ones will be more aware of like things like the dot-com bubble burst of I think 2001, the Wall Street crash of '87. These
Yep.
events, they result in the stock markets losing quite a bit of the value. So, how can the strategies, the information you posit in your book, manage the effects of such events and periods in such a way that someone can stay ahead?
Yeah, no, that's a brilliant question. So in the book, I cover two strategies, and in some detail, I provide investment plans for how to execute these strategies.
All
The
right.
first strategy, which is a real simple one, and the rules of the strategy are literally about 5 or 6 lines long, right? And effectively, what you do is on the basis that an index will never go to zero,
All right.
and with the reinvestment of dividends, the average time to recover the entire bear market loss is about 4.5 years. So in 2008, without the reinvestment of dividends,
All
the
right.
S&P 500 made a new high. So it recovered all of its loss. With dividends, it took about 3.5 to 3.75 years. It had recovered all of its loss. So if you invest in individual stocks, they can go to zero, as I said earlier. But if you invest in the index and you just continue to hold it and reinvest the dividends,
All right.
on average, within 4.5 years, on average, you're going to recover all those losses. So if you are, say, less than 55 years old, the idea is not to invest in individual stocks, is to buy and hold in a single or 2 or 3 index ETFs and reinvest the dividends and make your 401k contributions to that index.
All right.
When you get to your early 50s or 55 and older, and you now such a large fall in the stock market would have a bigger effect on you.
All right.
That's when you bring in what I call near passive, low effort timing of the market, and that's where you would exit the market. You'd go 100% into cash. When you get an exit signal, according to the technical rules that I've explained in the book,
Right.
or you could use some other timing method, and you go into cash, and that's how you avoid sitting through the entire bear market.
Okay. Interesting. Interesting. Okay, got that.
And sorry,
Go
I
ahead.
should add, Alex, that the timing is the second investment strategy that we've put into the book.
Okay. All right. Okay, got that. So, Gary, let's say that you meet with someone, okay, who has a nest egg or is building up a nest egg, may or may not have heard stuff like invest in long-term 401k, things like that,
Yeah.
and is really intent on not only having enough money for his or her retirement, but also, if possible, beating the market while doing so. And you had only enough time to tell this person one thing, the most important thing about investing to achieve their goal. What would be that one thing that you would tell that person and why?
Okay. The one thing would be to embrace the volatility of the stock market as the best performing asset class with the lowest costs, by investing in an index ETF, until you get to and invest your retirement contributions into that index ETF. You can cut fees by 20 times by investing in an index exchange traded fund rather than investing in active mutual funds, and to continue to reinvest the dividends and to add your contributions to it until you get to a point where maybe your late 40s, early 50s, you start investigating low effort timing, where you might exit the market 2 to 3 to 4 times a year to
Right.
protect your nest egg against a big fall. And it's that simple. It really is to stay away from looking at individual stocks and using investment advisors. Basically, do it yourself.
Nice. Okay, cool. All right, great. So, Gary, authors who write nonfiction books. They sometimes go on a journey as they do so. Now, I've heard that you told me that this journey lasted around 12 years for you. So,
Yeah.
I would presume that you did go on a journey as you wrote this book.
I did. I wrote a book in 2005, and I wasn't happy with it,
Okay.
because the way that I explained the strategy and the emergence of the instruments that I talk about in this book, which are exchange traded funds, was still in their infancy back then. And the market has now matured. The index exchange traded fund market is now matured. There's a lot of liquidity in it, and I wanted to finesse, not so much finesse, but to confirm the evidence of this strategy, and through more research and through execution myself in the market, and to also the style of the book. It took me some time to get correct as well, which is a conversational style of writing the book. So I'm mentoring a composite customer who's he's a fictional person. His name's Ian,
Right.
and
Okay.
I mentor him through the book. I did that to try and make a subject that can be quite gory and detailed, to
Right.
make it interesting and to keep people engaged.
Right.
And that was a fundamental change from the book that I wrote 10 years ago that I never published, because I didn't think that I got the material across in a way that would engage people and teach them, as I have done in this book, Blueprint to Wealth.
Right. Well, I can say definitely your book certainly it certainly engaged me. So, yeah. So, Gary, are there any last words of wisdom in the last few minutes of this interview that you would like to share to inspire our listeners?
Yeah, there's a chapter in the book, chapter 17, which is I make the statement to Ian, who I'm mentoring, that I believe by becoming a consistently successful investor, you can become a better person, and that is because of the traits that you learn of surrender, of big picture perspective, of empathy, of persistence, of resilience. These are the things that you learn along the way. So people start out wanting to invest for money, but they learn other skills along the way. And the only way that you can gain skills and you can be successful is to engage. Spectators that watch from the sidelines never learn. You have to engage, and you have to go through the journey, and with all the ups and downs that come along with it. And that means that you will make mistakes, but you need to have a benchmark that you can come back to, the basics, if you like, that you can continue coming back to and just get better and better at it. But you have to engage. You can't sit on the sidelines and outsource it and watch other people do it for you.
Cool. Well, great. So, thanks for those words of wisdom right there. So, in closing, the book is Blueprint to Wealth: Financial Freedom in 15 Minutes a Week. The authors are guest Gary Stone, and the website for Blueprint to Wealth is blueprinttowealth.com. That's one word, blueprinttowealth.com. So, Gary, thank you for your time. Thank you very much for being an Author Story. It's a real privilege to have you as our guest.
Thank you very much for having me on, Alex.
Cool. And as an addendum, I would like to mention to our listeners that we've only scratched the surface of things where the book is concerned. So if any of you want to know more, please feel free to go ahead and get, well, rather buy, since it's not for free, a copy of Gary's book, Blueprint to Wealth, which you can do so right now by going to the Amazon link in the description below the video. And if you'd like to follow our author interviews on YouTube, I invite you to subscribe to our channel. So, bye for now, everyone. I'll be back next time on Author Story with another inspiring author.